March of this year marks the 8th year since losses in the U.S. subprime mortgage market mounted into full-blown crisis at U.S. investment bank Bear Stearns, and months later at Lehman Brothers. A year of events that took the U.S. subprime crisis global. A recent South Center briefing for delegates at the UN Geneva addressed concerns that the crisis is moving in a third wave to the south after having moved from the United States to Europe. These clips of South Center Chief Economist Yilmaz Akyuz tell the story.
U.S. was the cause of the crisis, but U.S. has come out better than anyone else in the advanced world and better than many developing countries. During the crisis, there was a widespread perception that this would be the end of U.S. hegemony. It will be the end of the dollar as the major reserve currency. But when we look back now, we see that the U.S. is strengthening a lot more as a result of this crisis. Not only vis-à-vis other developed countries, Europe, European Union, or Japan, but vis-à-vis developing countries, including China, in economic terms. The status of the dollar as a reserve currency today is unchallenged because of the crisis in Europe. And the US has become so confident that it's trying to rearrange the global economic order according to its own priorities through BITs, free trade agreements such as TPPA, and its ratification of the IMF quota reform, to me, shows a sign of confidence of the US, perhaps in preparation that some major European countries will soon end up in the IMF. But the US economy is also fragile. Usually, economic expansions are often followed by contraction. This is part of the capitalist system working, boom-bust cycles. The US has had 24 quarters of expansion since the beginning of the crisis. And usually, recoveries age and die. And a lot of people simply on this observation that after 24 quarters of expansion, US recovery or growth is supposed to come to an end on historical evidence. But right apart from that, it's very difficult to get out of the policies that it introduced in response to the crisis. It doesn't know how to get out of the policy of easy money. It's very hesitant in raising interest rates. But on the other hand, if there is a slowdown in the US and a contraction and renewed instability, they don't have any ammunition to respond to that, because they used all the ammunition to respond to the last crisis, and they're still using it, except they don't purchase. We haven't had a serious debt crisis in an emerging economy in the past 10, 12 years. But the risks are very serious now. The world is caught in a debt trap today. Why? Because the resolution of European and American crisis, which was a debt crisis, the resolution of that crisis required cuts in debt. But what we've seen is that the policies implemented to resolve that crisis has given rise to an accumulation of additional debt. In the US, total public-private debt to GDP increased from 200 to 180%. In Japan, it increased to 500%. In the Eurozone and China, it doubled. And in developing countries today, it is close to 200% of GDP on combined private and public debt. And I believe in the next global downturn, that is, when your income drops significantly, an important part of this debt will be unpayable. When you lose half of your income, you cannot keep on meeting your mortgage or consumer debt, particularly if interest rates have risen. Unfortunately, policy space is much more limited today in developing countries than we had in 2009. At the time, we had a relatively comfortable fiscal position because of the previous expansion. We had comfortable balance of payment position, reserve positions. Now, we don't have any of these. The current situation has the similarity with the 1970s and 1980s. You will recall that European countries had a boom in commodity markets in the 1970s, accompanied by massive international lending by banks, repricing into oil surpluses. And this twin boom in commodities and capital flows to the European countries in the 70s ended up with a bust when the United States raised interest rate in 79, 80 with Volcker, and what we had was a debt crisis in Latin America. And the situation is somewhat similar. We had a twin boom in commodity prices and capital flows, and now we have this come to the end of this boom, even without the US changing its monetary policy in a big way. And the question is if the outcome will be the same as in the 1970s. We are highly vulnerable to both commodity prices and capital flow. The vulnerability to commodity prices nevertheless varies among developing countries because different classes of commodities fare at different rates. Some European countries benefit from commodity price decline, but no European countries would benefit from tightening of the external financial situation. Now, we cannot count on reserves. Traditionally, we look at the reserve adequacy in terms of their volume relative to short-term debt. But what's happened in the past 15 years, and we examined that in some research papers in South Africa, there is a very large presence of foreigners in domestic equity, bond, and deposit markets of the European countries. And it's them who are exiting. So therefore, your reserves may be adequate to meet your short-term debt. But if there is a massive exit from domestic bond, equity, and deposit markets, then your reserves will not be enough. Why will not be enough? Because you accumulated these reserves in the first place from their entry into your economy. Monetary policy now faces a major dilemma. In order to stimulate demand and growth, you have to cut interest rates. But if you cut interest rate, you can trigger capital outflows. So you have a dilemma between growth and stability. So if we face a liquidity crisis, that is, we no longer have enough reserves to meet our imports and stay current on our debt payments, keep current account, capital account open, what do we do? Business as usual, borrow from the IMF, keep the capital account open, continue allowing it to run out, using reserves and borrowing from the IMF and using austerity. Now, I think there is a strong misgiving vis-à-vis IMF among developing countries, and I'm sure that we should best to avoid going to the IMF in the event of a serious liquidity. I'm not referring to solvency crisis, default. I'm talking about simple liquidity crisis. You don't have enough foreign exchange to meet your current account need and debt payments. Then what we do? Of course, the opposite is you use your reserve to support your economy, imports, not to support capital outflows. Are we prepared to impose controls over capital outflows? Are we prepared to impose temporary and standstill? Are we prepared to impose austerity on creditors and investors rather than austerity on the people? These are the issues. Are there alternatives to the IMF in the provision of international liquidity? We have had some initiatives in the past 2 decades. One is the Chiang initiative in Asia. The other is the contingent reserve arrangement established by BRICS. But when I look at the design and their size, they're both inadequate. They're very small. No one has ever used Chiang Mai facilities. And they're actually designed as a supplement rather than substitute to IMF facilities. And in fact, they require IMF programs to have countries access to these facilities. Then we have swaps. We have swaps among central banks of developing countries. The only country that has swaps with other developing countries is China. China has about 30 swaps, but most of it is with advanced economies. And only one of them, the swap in Argentina, is designed to supplement reserves if Argentina comes under attack. And all other swaps that China has are designed to facilitate Chinese exports and investment. Can we do it without borrowing from the IMF? One way of doing it is to a massive SDR allocation. We had it in 2009 in the South Africa. We allocated this even before it happened. We can have a massive SDR allocation, but the question is, would the major shareholders of the IMF agree to that? In conclusion, even if we avoid a fully fledged financial crisis, the prospects are for sluggish, erratic growth and heightened instability in the global economy. Why? Because of financial excesses we have had in the past 8-9 years. And you cannot easily restructure your balance sheets. That is a problem. We need to have a better policy mix than we have been using. I have mentioned before, first, stop relying on easy money, which is no good except for speculation in advanced economies. Abandon fiscal orthodoxy, invest in infrastructure, and create jobs and create demand. Secondly, we need better control over international capital flows, not only by recipient countries, but by source countries. Because they are most destabilizing, they are in the heart of the current difficulties that we face. Third, we need the mechanism for adequate provision of international liquidity. And finally, we need effective and equitable debt resolution mechanism. Now, these issues should be studied and debated extensively, particularly at the current juncture. But unfortunately, Bretton Woods institutions are not the best place to do that, either to understand the fragilities or to resolve the problems. IMF has missed one of the most serious crises in the world since the Second War, the subprime crisis. IMF at the secretariat level is not very efficient in providing early warnings to countries about the global economic situation. And this issue is not just a technical expertise issue, it's a political issue. Because such an early warning, effective projection of the difficulties in the world requires a critical examination of the policies of countries which exert significant impact on the world economy. That means it will require criticizing US and European advanced economic policies. That IMF Secretary cannot do that. That's why they cannot really predict these kind of difficulties, warn countries in advance, warn them during their expansion so that they don't get into trouble. When we were writing The Rise of the South was a myth in 2009, 2008, IMF was promoting that the South is becoming a locomotive for world economy. And they changed their mind only in 2013. Secondly, IMF is not very bold in innovation. These difficulties are serious ones, and you need bold measures. They are not bold in the reform of the international financial architecture. Why? Because IMF is part of that architecture, and that requires the reform of that very same institution. So I believe that these matters should be discussed, debated among developing countries, and in other forums such as UNCTAD, which has a much better record in anticipating these difficulties and providing proposals which eventually became part of the mainstream.
We have to leave it there. For viewers who'd like to dig deeper, please see the context link to this story. Special thanks to Yilmaz Akyuz and the South Center, and thank you for joining us. From Geneva, this is Lynn Fries for the Real News Network.